Awesome. Well, welcome everybody. This is our first live session with RMI. We thought we would start to host a one-on-one live Q&A session. We'll probably do these once a quarter, so as you happen to have questions, feel free to always write them down, send them in, and once a quarter we'll do a little session where we can ask myself or one of the other partners at the firm some questions and get them answered right away for you. In the meantime, just to fill everybody in on some of the background of our firm, we've started doing some newsletters recently. So anybody who's interested, you can always go to our website, accountantscalgary.com, and subscribe. We will be sending out newsletters occasionally and periodically with just accounting tips, some information, reminders about deadlines. Of course, we're right around the corner from another personal tax season, so that's going to be coming up soon as well. In the meantime, I see some people are starting to join in, so welcome everybody. And as you have some questions, feel free to add a comment and make a post here, and we'll start going through some of the questions that everybody has. In the meantime, we did get a couple questions. I'm just looking up here in advance, and so one question that did come in prior to our webinar was regarding registrations in provinces. So the first question I'll tackle is this one here, and the question was basically asking if it was an Alberta-based business, moved to BC, extra-provincial registration was done for the province of BC, but then later decide to close down in BC and just relocate back to Alberta, what options exist for that BC entity? So I'll elaborate a little bit on this whole piece here. And when we're talking about extra-provincial registration, what we're really talking about is the registration of your company in that province. So it doesn't mean what happens when we do register essentially is you are required to keep your registration active in that province. So there is an additional cost if we go and register in every province across Canada, for example. So in this instance, if we're no longer operating in business, you have two options. You can dissolve the business entity, the BC entity, and keep operating in Alberta. Or if you do not file your registration there annually, at some point it will dissolve as well. From a tax standpoint, what actually happens is you pay taxes based on head office expenses as well as salaries in each province. So if you have no head office in BC anymore and you have no salaries that you're paying in BC, from a tax standpoint, you're only taxable in the province of Alberta. So I hope that helps answer that question. I see another one come in here. If you have a business license under your home address, do you need to renew it every year? This is a little bit of a tricky question because business licenses actually fall under the jurisdiction of where it is registered. So being out here in Calgary, there's obviously the City of Calgary rules. If we're talking about surrounding areas, Chestermere will have its own rules, Strathmore will have its own rules. So when it comes to business licenses, more often than not what happens is a business license needs to be renewed each year. Some businesses do not require a business license. And so visiting the websites of the jurisdiction you're in, I don't want to go through all of them because there's so many just in Calgary alone, yet alone across the country. But if you go into details, most of the city or county websites will actually have a checklist that says, do you actually need to register and apply for your business license? I see another question come in here. What are some of the common business financing options? That's a very interesting question there, and lots of answers I can give around that. So I'll talk a little bit around financing for businesses. So of course, when starting up a company, if you walk into the bank and say, I started this company yesterday, can you lend my company some money? The bank's gonna probably say no chance. So how do you get a business started with financing? Your options are obviously personal money. You can get investment capital through friends and family. I'll touch on that in a minute here because there are some rules around that. But speaking about banks, then banks, of course, will lend you money, but based on your personal credit. So when starting up, for example, a new company, you can go get a personal line of credit and invest that into the business. You can apply for a business loan, but with a personal guarantee. BDC is a great option for new startups. As your business grows, you can look for some investment capital, like I mentioned. When you're bringing in friends and family, you're typically okay. But if you start bringing in multiple shareholders, you got to start to be careful about not falling under securities regulations. Otherwise, your company has to be registered for that. So it's really important to make sure you're talking to a good accountant or advisor about your situation specifically when starting to bring in investment capital, because you want to make sure you're safe on that side. And of course, once your business is operating, it opens the doors for, if you've got a successful company, going public can help raise some more capital, looking for outside investors, or of course, a lot of times what people will do is they'll start a service-based business, start generating sales, use that capital then to further reinvest into the company. I hope that helps answer your question there. Next question that came in here, just pulling that up here. So what home office expenses can you claim as an individual? So as an individual during COVID, we were given some specific home office expense allocations, and they were allowing a benefit of $2 per day that you were working at home for COVID. Outside of that, and this is something that will be important to keep in mind going forward, if you're an employee, for example, and you do work at home, you are able to get approval that you are needed to work at home from your employer, and you are able to write off a percentage of your expenses. This includes a portion of your mortgage interest, a portion of your utilities, a portion of your property tax, insurance, especially if you're a business owner, you have an incorporated company or sole proprietorship, you can write off the same expenses because typically you do have a home office when you're working away. So it is important, keep track of your utility bills. I know a lot of people get them and just pay them and throw them away, but anytime you're doing any type of business or you're working from home as an employee, make sure you're keeping track of your employment expense or your home office expenses like utilities, mortgage interest, rent, property taxes, insurance. Okay, great. I love that there's lots of questions coming in. This is fantastic. So thanks everyone for your participation, and keep sending your questions in. I have another one here. Should I use cash basis or accrual accounting? So for those who are not familiar with the difference, let me touch on that first. So accrual accounting is a terminology created for accountants that basically is trying to do a few different principles, but one of the main one is considered matching. And so we want to match your revenues and your expenses into the periods that they were actually incurred. So for example, when we talk accrual accounting, if you're a company and you invoice a customer, that sits as a receivable. Even though you haven't received the cash, we are recording that income coming in. And so from that standpoint, what happens is you are paying taxes or saving taxes based on just the invoice periods for clients and customers that you've invoiced or received invoices from. Cash basis is basically exactly what it sounds. So you will only record revenue and expenses once you've received the money or you've paid it out. As a business owner, you are required to file your taxes based on accrual accounting. So I typically recommend that. But as an individual, and our personal taxes are actually based on cash basis accounting. So if you are a sole proprietorship business, if we're just talking about rental income and expenses, you can actually claim that on a cash basis. And rental one's actually really key, because a lot of times you might have a tenant who's 2 months behind and hasn't paid you. Well, in that case, you actually don't have to claim that rental income until the next year when you actually receive that money. A few questions here to catch up on. So can house rental claims as office expense or only as home office? So when you have a rental property, then your expenses are in full. So when we're talking about an actual rental property, your mortgage interest on that, your insurance, property taxes, even some property taxes, even so your insurance, for example, or repairs for that property are all deductible against the rental income you've earned. Home office is just for your house. If you are renting a portion of your own house, then we can write off additional expenses. So for example, some people will live upstairs, rent out the basement. So a portion of the expenses relating to the basement can be a write-off against the income you're earning in. Hope that helps answer your question there. Next one, what would you recommend to start up a business in regards to keeping the records, track of the records, taxes, and so on? So this is a great question, and we're talking about starting up a business and really the bookkeeping around it. And I recommend a software, something like QuickBooks, for example. And the reason it's nice to get going on this right away is because it's very easy to fall behind. What I've seen many clients in the past do is they just focus on the sales of the business. Let me get income in, let me get income in. 2 years later, they're coming to me and be like, CRA is phoning me and I don't know what to do. Well, at that point, the problem is you're already 2 years behind on GST payments, if you've earned income on taxes, and it's very, very difficult to actually catch up. So I recommend start something, QuickBooks. We can always assist, or another advisor can always assist in getting you set up properly, training you how to use the software. And as long as they're using it properly and staying up to date, it's really not that much work. A couple hours a month even sometimes, and you can have your records kept up to date. And the nice thing is, you can always monitor how your business is doing. So it's super important. You can see, how did you do month over month? Are you actually growing? Are you shrinking? Are you spending too much? And you can do a lot of planning once you actually have the proper numbers around it. Okay, another question came in here. Can subcontractors having his own corporation but work for one corporation, will they ever be treated as or deemed as an employee in the future by CRA? This is another really good question, and we're talking about employees versus subcontractors. So the difference between the two, there are a few different rules around it, and CRA is open to deeming a subcontractor as an employee in the future if the rules are met based on the criteria I'll talk about right now. So there is no limitation that CRA can actually change this. If they come in and they're conducting an audit, they see that somebody's a subcontractor, but in reality they meet the definitions of an employee, they will change that person to an employee, and tax, both parties actually would get hit with some taxes on it. And the rules to really look for are very simple. Who is providing the tools for the job? For example, if you take our accounting firm, for example, who's providing the laptop to work on or the computer to work on? Who's providing the office space and the desk and the chairs? Another big factor is who's making the schedule. Is it me giving somebody a job saying, okay, here's XYZ file, this is how much you're going to be paid, and you go do it yourself and you figure it out? If it takes you 50 hours or 5 hours, it doesn't matter. So we've always got that option there. Or the other side is, are they an employee where it's set, okay, you need to be in the office from 9 to 5, here's your budget on the file, I'm paying you hourly, so if it takes you longer, it's still my job and my risk as a business owner. And risk is the big one. Where is the overall risk taken for an employee versus a contractor? So as a contractor, they have the risk. They have potential losses for if they're taking too much time, if the client doesn't pay or anything like that. Versus if it's an employee situation, the business owner actually has that risk. And so it's really important to make sure you set the arrangement up properly if you want to be a contractor arrangement. So then this way you can avoid any future penalties and taxes from CRA. Glad we got lots of people on here, which is fantastic. So for our first live question and answer, we're getting a good response, which is awesome. As I mentioned earlier, feel free to type your comments and your questions. I'm slowly going through them and getting caught up, and we'll be doing these live one-on-one webinars or Instagram lives probably on a quarterly basis. So even after this, if you've got questions that come along, always reach out or save them for the next live one-on-one. So I got another question here. What's a holding company good for? Well, that's fantastic because people who know me know that I'm a big fan of holding companies. And the reason for this is the benefit of a holding company is twofold. When you have an operating company, it typically carries some sort of liability with it. And so if you want to start to actually have a successful business and you're saving up money and you want to know how to invest it, if you invest it through the operating company, there's a couple issues that come up. One is it could actually, if you do ever get sued, somebody can go after that money. Two, it makes it very messy from an operating standpoint. If down the road you want to sell or bring on partners or do something like that, it complicates it because you've already created this big investment pool. And so having a holding company allows you to funnel money from an operating company to a holding company tax-free when it's structured properly. And the benefit to that is now you're moving profits and profits from a operating company into a holding company, which reduces any liability in your operating company. So if somebody comes and sues you, the good thing is you can typically say, you know what, I can close that business down, or there's no activity, there's nothing there. I'm going to go and relaunch a new company. And all your investments and your funds are safe inside of a holding company. And the biggest benefit too is from a tax standpoint, if you want access to this capital to invest, you don't have to take it out of the operating company. So in Canada, our personal tax rates are some of the highest rates you actually pay in taxes. And so when we can actually have, when you can keep more money inside of a small business in Canada, especially if you're under $500,000 of income, your tax rates are significantly lower. In Alberta, we're talking only 11%. And the nice thing about that is keeping more money in your corporate structure gives you more after-tax money that you can invest and do different things with. Got a few more questions here. So what is a better way to withdraw from the company between salaries and dividends? That's a great question. I get that quite often, actually. There's a few factors to consider for sure. The first factor is salary and dividends, your tax rates are pretty close to each other. Right now there's a small benefit if you take a salary, but it depends on the total amount and the income between the actual taxes that you're going to pay. So the factors that I always consider, the first and the big one is CPP. If you're on salary, you have to contribute into CPP. And as a business owner, you're not only paying the employee portion, you're also paying the employer portion. So right now that works out to be almost about $5,500 for a person on the max rate. Now the benefit is, of course, if you're paying into CPP, when you retire, you will be entitled to more CPP. But a lot of times people say, you know what, I want to keep my own investment money. I don't want to be contributing into CPP. So you can actually pay yourself as a dividend. And in that case, you don't have that CPP portion to pay. Some of the other factors, RSP limits, depends on your structure. Sometimes they're good, but a lot of times they might not be the best option. But if you do want to increase your RSP room, that can only be done through salary. And some of the childcare benefits. So if you do have kids, it's sometimes worthwhile to consider going on salary because childcare benefits actually go to the lower income earner based on employment income. So if you have a husband and wife, one's working, the other's a business owner, and that business owner is taking out dividends, you actually don't get a write-off for your childcare benefits. So in that instance, it may be worthwhile to say, let's take that business owner, give them a salary as well to maximize on the childcare deductions. Hope that helped answer your question there. Couple more has come in. So when is the right time to incorporate my business from a revenue perspective? This is another one that I get asked very often. Revenue is one factor to consider. So the situation we'll talk about here is when to move from a sole proprietorship and actually become an incorporation. Couple factors to consider. One, what's the liability potential? If you're starting up a business that has risk, even if you have $0 of revenue, you may want to incorporate, because at the end of the day, if you get sued for anything, you don't want them going after your own personal assets. So it's not always about revenue, but if you're doing another business that has very little risk with it, sometimes operating as a sole proprietorship is best. But when you want to start to look at incorporating is when you can start to save money inside of the corporation. So again, our corporate tax rates in Alberta, for example, under $500,000 is only 11%. So if you're making $50,000 of profit and you're able to save that inside the corporation, because let's say you might be an employee elsewhere, then that can be a huge benefit for you to incorporate, because you're only paying the 11% tax, which gives you more after-tax money to then reinvest into other projects, compared to actually being a sole proprietor, where that $50,000 might get taxed in and around a 30% average rate, depending on where your income is. But you can see that extra 20% tax you're paying, if you're able to save that money, invest it through the corporation, you can actually come out a little bit ahead. So it's not always about a revenue generation. The two things I look at are, one, what's the risk with the business you're doing? And the second big factor is how much income can you actually save in your corporate structure. Awesome. So I think I'm caught up with some of the questions. If the more are coming in, for sure, please continue sending them in. I'm here for a little while, so I want to make sure it's a chance. A lot of times people like to send in a question, but then they're not always comfortable with the answers they're getting, or they've got follow-up questions. So now's the chance. Ask away. If you've got follow-up questions, please join in, and feel free to write down some follow-up questions on what I'm talking about. So here's another one. What are examples of tax write-offs for business owners? So the nice thing is our Canadian Tax Act is actually pretty subjective when we talk about expenses. There are some rules around expenses for sure. Some of the big ones is, many people will be familiar, meals and entertainment, you're only allowed to claim half, for example, or golf dues is a non-deductible tax item. But overall, when we're in an audit situation, the key is, what can we justify that we had to spend that money in order to earn income? So for example, a common one might be season tickets for let's say it's the hockey, so for the Flames. Well, is that a deduction for the business? Well, is it something that you provide to your employees as incentive, for example? Is it something where you take clients out? Is it something that you and your family go to? So there's a big difference. So yeah, of course, if it's you and your family, then that would be more of a personal expense. But if it's something you're using inside of your business, you're treating clients, you're giving it away as prizes or gifts or anything like that to continue to help expand the business, then that is something that we can for sure write off. So it is very tricky on that one. What I tell a lot of my clients is, feel free, ask us questions, give us a call. Either myself, another accountant at our office, we're always happy to help decipher, especially those ones that are a bit more questionable. Are they actually a business write-off, or is it something that we got to pay on the personal side? Another good one here. What is income splitting and what does it mean in terms of taxes? So income splitting is very interesting because in 2017, the Liberal government did change some of the rules around this. So what used to happen back in the day is a business owner might be making some good income, $200,000, $300,000, $400,000, $500,000. And what they would do is they would hire their own children, their spouse, in terms of working. In 2017, the rules changed where it actually has to be a form now of hours worked and some sort of compensation around that. So if you've got a husband and wife full-time in a business together, for sure you can actually split the income. And what splitting the income means is sharing the profits that you need to take out personally to bring you both down into a lower tax bracket. So depending how much money is being taken out, sometimes we allocate a certain amount to husband and wife. But the one thing we got to be careful of course, is in this day and age, if you've got somebody who's full-time in the business and somebody who's part-time, the income has to reflect the same. There are some mechanisms around it. For example, if you've got a holding company that's earning dividend income or investment income, then shareholders are entitled to it. So the rules can get a little complex around it. So for sure, talk to a tax professional if you've got more in-depth questions on that one. Couple questions I got to catch up on here. So let's see the next one. Provide some information about capital dividends paid to shareholders. Oh, this is a fun one. So capital dividends are actually a massive benefit, and I feel they're under talked about for the benefit that they actually have. And what a capital dividend is anytime you're a business owner and you've got a company and you sell an asset for a capital gain. So for example, you have a property or a warehouse inside of a company, you sell it 5 years later, you have a $200,000 capital gain on the property. You only pay tax on half of it, so 50%. The other 50% actually goes into this account called capital dividends. It also applies to people who have corporate policies of life insurance. When that life insurance gets paid out, it goes into this capital dividend account. And what's nice about the capital dividend account, it actually can get paid out to shareholders tax-free. So it doesn't hit your personal income. It comes out straight away. There is an election form that needs to be filed to take it out with CRA. But beyond that, it's basically an avenue of you can take out money from your company tax-free for that equivalent amount. So some very, very neat, interesting tool. Always worth keeping in mind if it applies to you. How do RESPs and RRSPs affect individual personal taxes? Do they both act the same way if I'm making it for me and my kids? This is a very fun one because although they sound very similar, RESPs and RRSPs get treated very differently. So RRSPs, when you make a contribution, it becomes a deduction on your tax return, on your T1 tax return. So a lot of times if you're an employee, it can lead to bigger refunds or offset some other income you might have. RESPs do not act as a tax deduction on your personal return. Similar to TFSA, they don't get deducted on your tax return either. When you pull out the money, so RRSPs, when you take it out, you're allowed to take it out at any time, but it gets added to the income you've made. So a lot of times people will leave their RRSPs till they retire. You have very little income once you retire, and you can pull it out and stay in a lower tax bracket. Plus you get the growth benefit of the RSP over that time period, tax-free. An RESP, meanwhile, will actually get taxed when you pull it out as well, but typically it will go to the child as long as they're going to school. So it's a nice benefit there because you can push some income over to your kids in the future by contributing into an RESP. But there is no deduction on it up front. So it's after-tax money that is being invested in there. Here's another question here coming in. So thoughts on if a shareholder wants to obtain a mortgage in their holding corporation due to current low interest rates? Oh, that's a good question, and it has become more popular lately as well with interest rates as low as possible. A lot of people are looking for either a property for their own company or for rental property purposes. And there's a couple different things we can do around this. So if your company can support a mortgage and qualify for it, it's a great way to have cash inside of a holding company. You don't need to take it out. You don't pay the higher personal taxes. Instead, you can actually use that cash inside of the company, buy a property as your down payment, get a mortgage through the holding company, or sometimes depending if it's a big commercial property and depending on liability, we may even separate it into a separate real estate corp, for example. So it is an avenue that you can really take advantage of. I think there's a lot of benefits. If it's a warehouse or something for your operating business that you're buying, the good thing is the passive income rules don't even apply. So it's really a great way to be able to take advantage of cash that you have saved up, paying less tax on it because it's been inside the corporation, and be able to actually go ahead and qualify for a mortgage. Now, a lot of times banks don't like this. They want to see personal guarantees, but there's lots of ways around it. And one of the big things I'll touch on here is CRA doesn't always look at title ownership. CRA looks at beneficial ownership. And the difference is when CRA is looking about who actually owns the property, they're looking at who gets the benefit for it. So sometimes what will happen is the person is only qualifying as an individual for a mortgage. And when they do that, what we'll do is we can do a trust agreement that says that the property is in their name in trust of their corporation. So that allows us with CRA to actually treat that as a company asset at the end of the day and still take advantage of the savings or the cash savings that we have inside of a corporation. So I'm going to take a few more questions here. I see some more coming in. So with all these new apps like TurboTax is coming in, why are accountants still needed, especially for personal taxes? That's a great question, and there is for sure a lot of the tools and a lot of the softwares that are coming out can help prepare your tax returns. A lot of times if you have a simple one that's just a simple T4, I would recommend going to something like the software because they can do the calculations just as easy as us and it'll save you some money. But where you want to talk to an accountant is where the complexities begin. If you've got multiple rental properties, if you've got maybe employment expenses that you qualify for as a deduction, if you bought a new house, there's some tax benefits for that. So there's a lot of little nuances and little rules that even the systems, they do pick them up, but they're asking you a simple question that you might not have the answer for. And that's where something where you can engage an accountant and ask the one-on-one questions and make sure everything's being picked up correctly. That's where you'd want some additional support. What tends to happen a lot of times is if you're not working with the right professionals and there's complexity, if you've got lots of investments or different things like that around your personal taxes, CRA, if it triggers an audit, they don't care about what software was used. They don't care about how you prepared it. They don't care what system you can blame. At the end of the day, you are responsible for filing your taxes. And so if there are any complexities and things can get more confusing, the apps sometimes can't answer the questions that you need answered in order to make sure the filings are done correctly. So that's where you come and see an accountant. And of course, if you've got a corporation, there are still softwares for it, but the complexities get even more. You have to really have a good, strong basis of accounting, accrual accounting, and how transactions flow. And so that's where when you have a company, you for sure want to be reaching out to a good tax professional there. So I think that's a lot of the questions that have come in. I want to thank everybody again for joining today. I think it's been great to see the response we've got for being our first one-on-one live Q&A session. Thanks for all the questions. If you've got any more, still here for a couple more minutes. But otherwise, I'd just like to remind everyone, we're RMI Professional Corporation out of Calgary here. You can always find us online at calgaryaccountants.com. We have started doing newsletters, quarterly newsletters that we continue to provide good information, tax tips. We'll always be giving you information on when our next one-on-one session will be as well. So please go to our website, subscribe for that. And if you have any questions at any point in time, you are always available. If it's not myself, we've got an office that continues to grow, so lots of good, talented people here, and one of us will be able to answer all your questions. Thank you, everyone, for joining today.